Have you ever felt jealous of not being a part of the world's biggest companies and businesses? Like, why couldn't you have the idea of creating Apple, Amazon, or Google first? Well, it's certainly quite late to think about that now, but what if I told you that with as little as $1,000, you could become a shareholder in multiple world-class companies like these? Pretty exciting, isn't it? Well, in today's video, we will be breaking down the stock market for you and teaching you a secret infinite passive income strategy for never running out of money again. But before we do that, please note this video is not financial advice, and any money you invest into the stock market you could potentially lose. Also, keep in mind that I'm just a random dude on YouTube, and you should always do your own research and due diligence when investing into the market. Now, with all that out of the way, let's get into the video and start by learning a little about the history of the stock market. So when we think about the stock market, most of what comes to mind is the ease of access and the automation surrounding it investing these days. However, investing back in 1531, when Belgian moneylenders began exchanging loan agreements and bonds that function similarly to stocks today, soon afterward, shares of companies began changing hands on paper, and brokers used to mail these handwritten shares to investors who were interested in the trade. Now, talking about modern stock exchanges, you'll be quite shocked to know that the NYSE, or the New York Stock Exchange, was not the first stock exchange in the world. The ASE, or Amsterdam Stock Exchange, publicly traded shares of the East Indian Company and gave birth to the first official stock exchange back in 1602. However, 19 years after the London Stock Exchange was formed, the New York Stock Exchange came to life. It is crowned as the most powerful stock exchange in the world, listing 2,584 publicly traded companies with a combined market cap of $26.2 trillion today. So now that we've established the past, let's move on to the future and find out how the stock market works. So, to make it simple, just think of a company as if it was a giant cake, and everyone at the party owns a slice of the cake. Similarly, a company's shareholders all owning a slice of the company. However, where the two differ is that to own a slice of the cake, you need to be invited to the party, whereas to own a slice of the company, you need to invest money in it or buy what they call shares. So let's take Amazon here as an example. If you want to own a slice of Amazon, you'll need to purchase its stock, which is currently listed for $114. But why do stock prices keep going up and down? Well, multiple factors determine the price of stock, but the most prominent one is its supply and demand. Translating that into simpler words, if Amazon seems to be doing well and more people demand to buy into it, the stock price will go up. On the other hand, if Amazon appears to be declining because of tough competition from another revolutionary e-commerce company and people begin selling their positions, the stock price will fall. However, the stock price going up is not the only way for investors to make money with the stock market, as this is where dividends come in. Okay, so what are these dividends now and how do they work? Well, we've discussed dividends quite a lot on this channel, but for anyone new here, dividends are just small cash rewards paid to the shareholders of a company if it makes a profit. So it's technically the company's way of saying thank you to the people who believed and invested their hard-earned money into it. So to understand dividends even better, let's take a look at another example here. Coca-Cola is currently trading at $58 per share and has an annual dividend yield of 3%, which means that for every $1,000 you invest, you'll make an annualized return of $30. But a 3% dividend yield sounds kind of boring, doesn't it? Well, different companies offer different dividend payouts. So if we talk about a company like Lumen Technologies that leads the telecommunications sector, it's trading at around $8 per share right now and has an insanely high annual dividend yield of 12.4%. However, do keep in mind that dividends are not owed to you because they're tied synonymously to profit only. If a company misses out on its quarterly or annual dividend payout, it could either mean that it's facing financial strain, not generating enough profit, or simply needs to maintain a certain cash balance for the time being. However, in any case, even if the company completely stops paying dividends, you still can't take action because you weren't obligated to it in the first place. But wait, there's more for you in this. It's finally time to tell you about the main highlight of today's video, which is the infinite passive income strategy. So gone are the days when you need to worry about receiving your paycheck on the 21st of every month. Now it's time to make a passive income and never worry about going to work again. So to get going with this, you need two simple things first: a brokerage account and a stock portfolio. Well, yes, you'll need to go through the hassle of setting up a brokerage account because that's where you'll be developing your stock portfolio. Your portfolio should consist of diversified blue chip companies from multiple sectors and industries, because having your passive income flow in from just one sector could be a big risk. Remember to never put all your eggs into one basket. And if you're wondering what blue chip companies are, then the term blue chip simply refers to well-established companies that have a constant track record of good performance. Some of the most prominent ones include Apple, Microsoft, MasterCard, AT&T, and even Coca-Cola. Now, once you've invested into such stable companies, your portfolio has come to life. Next, it's time to figure out the other two important elements of this strategy: your expenses, which is the amount of money you need to sustain your life after retirement or right now, and your portfolio's annual dividend yield, which is the combined average percentage your stock portfolio will be paying you annually. So this could be anything from 2% to even 15%. Now it's time for applying all of this to the formula, which is your expenses dividend by 0.0 your annual dividend. The 0.0 simply means that you move your figures to the left side of the decimal twice. Yep, it's that simple. So let's put this into perspective now. So let's say that Harry's annual living expense is around $40,000, which is a solid average for most Americans as well. Now, if we take this figure and we divide it by 0.08, 8 being the dividend yield of Harry's stock portfolio, we get $500,000, which is the amount he needs to invest in order to make $40,000 passively. So although $500,000 may sound quite like an unreal amount of money to have, once he starts setting aside a portion of his salary to get the stock portfolio there, Harry can quit his day job and won't have to work anymore. Now, the best thing about this strategy is that not only will Harry be making money while he sleeps, but he won't ever run out of money again, since his stock portfolio pays him more than he needs to spend. So now that we're coming to an end, I'd like to share another secret strategy with you. Did you know that dividends aren't always paid in cash, and some can even be paid in the form of knowledge-packed YouTube videos? Well, you'd be surprised to know that if you scroll below and subscribe to the channel, you'll be in for this bi-weekly dividend reward as well. So don't miss out on this opportunity, because in the long run, the dividends of knowledge might outvalue the ones paid in just cash. Anyways, that is enough serious talk for today, guys. I will see you in the next one soon.